So friends, good evening and welcome to the fourth day of 50 hours education course under Rule 5.1. Today we are going to start a very easy and very scoring topic, that is principles of insurance and loss assessment. For examination, it is of 3 marks and the weightage is 3 marks and it is very scoring. And if you are lucky and if you get a case study out of this topic, then it may be of 8 marks or 6 marks. तो ये टॉपिक आपको सिर्फ 3 मार्क के लिए नहीं पढ़ना है, मिनिमम 10 मार्क्स के आसपास आपको एग्जाम में ये आ सकता है। स्कोरिंग इसकी ऑलमोस्ट 10% है अगर केस स्टडी आपको एग्जाम में आ जाता है इसके ऊपर। So without wasting much time, I would like to introduce our faculty for this session is none other than my friend and our member N.V. Harihar Raoji. About his qualification, he is AMII and M.Tech in structure engineering, and he has served 32 years in public works department and recently retired as a chief engineer of government of Orissa. Welcome to the class. Namaskar, sir.
Namaskar, sir. Thank you.
Namaskar and welcome to the class, sir.
Sir.
Can we start, sir? If you
yes, sir.
Are ready with the PPTs and other.
Yes, we can start, sir.
Okay. Please take the chart for this session.
Okay. Good evening to all. Actually, we are
sir.
going to take today a topic about insurance for building and how to apply for the claim and how the claim settlement is done. This is a very good subject and a very scoring subject. As sir told, it is nearly minimum 10 marks you will be scoring. Because by studying the case studies, you are not going to see only insurance, you are going to again revise your cost approach. It is the basic of this case study will be cost approach. So already you have studied cost approach, again you are going to revise it. So let us start with the presentation. I am sharing my screen. Is it visible?
Yes, sir.
Yes, sir, it's visible.
Okay. So the topic is insurance principles. And here we are going to discuss about the MCQs also. We will discuss about 25, 26 MCQs we will be dealing and some 5 to 6 case studies. So the entire thing will be covered within these 2 hours. Please attend very carefully. If you have any doubts also, you can note down them and we can discuss at the end. So now let us start with this topic. So first of all of you know about insurance because maximum of you would have done your life insurance. Similarly, for your car insurance, you would have done. But many people don't go for property insurance. If you see here, if you are having some 50-60%, out of 60, 1 or 2 may have this property, this insurance. So this is a very good item. That is, what is insurance actually? If you see what is insurance, it is if you have a property or a building to safeguard against any financial loss due to any unforeseen event, that is any accidental, any acts of God, then the insurer company will give you the financial loss you have suffered. So that means the owner of the building, who is the owner of the building, he is called your insured, and the person who is making your insurance, he is called the insurer. Why this is disabled, sir, for yours? I don't know why till now it was working. Okay. So what happens? The insured person, the person who has insured his building, he pays premium to the insurer. And in turn, the insurer gives financial protection to the person who has insured it. So it is a contract. It is a contract between the insured and the insurer. So what type of contract? Already contract you would have studied. Here we will be telling this contract as unilateral contract. Sir, some problem this slide. Let me see. Okay, now it will work. Okay, let us first go again back to the syllabus because the slide was not visible earlier. So these are the topics we have: the principle and legal concepts in relation to insurance, buildings, contracts of insurance, insurable interest, liability to insure, duties of the insurer and the insured. These duties of the insured and the last one, obligation and rights of the insurer, are more or less same. Then we will see types of fire policies, reinstatement value, indemnity policies, etc. Then what is the value at risk, sum insured, etc. And premium preparation of claim for damages. Now here, as are told, though 3% weightage is given, but extra up to 6% minimum, that is 9% you get, and sometimes even more than that you will be getting. So please give more importance to this because it is a very easy subject and very scoring subject. So now this one we have already seen. So there is two persons who has taken the insurance is called insured person, and who is giving the insurance, like any insurance company, any general insurance company, he is called the insurer. So you pay the premium to him and he gives you the financial support. So now here a contract between insured and insurer by which the insurer gives financial protection against future uncertain losses. This what is very important. Future uncertain losses. That is, in general wear and tear, if any damage comes to the property, the insurance will not cover it by charging a consideration called premium. Here insurance contracts are unilateral. Why it is called unilateral? You see, once you pay the premium, the insurance company is enforceable if he is not paying your claim. If it is legitimate claim, the insurance company has to pay you the loss. But suppose second year you don't pay the premium, nobody will enforce you. So it is one-sided. Once you pay the premium, the person, the insurer, has to carry out the loss. Any loss is there, he has to pay you. So that is why it is called unilateral contract. Similarly, this is also called conditional or contingent contract. This also you would have studied earlier: contingent contract, then implied contract, express contract, like that many contracts you would have studied. What do you mean by contingent contract? It triggers only on happening of an event. Something will happen, then you will get. So the other lease contract, let us say, after 1 year, automatically he has to pay the lease rent. But here, if within that 1 year no damage has come, he will not pay you. So only on happening, these are all one MCQs, kindly note. Insurance is a dash type of contract, he will ask. So there it will be there contingent contract or unilateral contract, like that. Okay. Now, what are the key points here? First of all, you understand when you have insurance for a property, you have a property means it includes land and building. So generally, land is not destructible. This has come number of times, MCQs have come. Land, for land, that's why no insurance can be done. So only for the building portion which is destructible, that for that only you can do the insurance. Now, second thing, in general, foundation part, that is below the ground level, the foundation is not included in the insurance. So now it is very clear, when you say a property to be insured, for what value it has to be insured. That is called insurable value. This insurable value, now you are able to know, it is nothing but the value of the property minus the land cost minus the foundation cost. Only the portion above ground or the superstructure of the building is insured. That is the very first fundamental point you have to understand. Is that clear? So mainly this point, this land is not destructible. This word you please remember. And second one is the foundation is excluded. No foundation will be treated. Now, what is the role of valuers for this insurance? That is now a very important point. So I will just explain here. So suppose a building you have and the building's insurable value. Now we call this as insurable value IV. Let us say this is 100 lakhs. What is this insurable value? This is nothing but only the building cost above ground level. Now suppose a person has taken a policy amount, that is he has insured the property for let us say 50 lakhs. Your value is having an insurable value as on today, that is on the date of loss. That is another very, very golden point you have to remember. The insurable value is nothing but the net present value at the time of loss. Suppose the policy amount is 50 lakhs. Then what we can say? Your insurable value is 100 lakhs, but you have insured only for 50 lakhs. That means you are underinsured. Suppose in this case, there will be a damage of 20 lakhs. The company will not pay you 20 lakhs because you have not insured for 100 lakhs. You insured only 50 lakhs. That means 50% only you have insured. So he will also pay you only 50% of this, that is 10 lakhs he will pay. This is called underinsured policies. Is that clear? Now let us say, we'll assume like this, that now he has just insured for 120 lakhs, let us say. Instead of this, he has insured for 120 lakhs. So what will happen now? Suppose now there is a loss of 50 lakhs in your property. Now the insurable value is 100 lakhs, but that person has insured for 120 lakhs. So he has sufficiently insured, or in this case, we call it as over-insured. Then he will be getting that full 50 lakhs.
Friend, this is the most important concept to be understood in this insurance and loss assessment. अगर आपको ये समझ आ गया और इससे रिलेटेड 1 मार्क का या 2 मार्क का कोई भी केस स्टडी आता है या एमसीक्यू आता है तो आप अटेंड कर पाएंगे. Yes sir, over to you. Sorry to.
Yeah, but another interesting thing you have to understand here, you have your insurance value is 100 lakhs. What do you mean by that? That means the value of the property, the net value of the property on the date of loss is 100 lakhs. Suppose a person claims I have lost 150 lakhs. What the company will do? Your property is having a value of only 100 lakhs. You are telling that your loss is 150 lakhs. So he will not do this. He will limit this to again 100 lakhs. And pay you only 100 lakhs. Though you have gone for an insurance policy of 120 lakhs, he will not pay you 120 lakhs. This is called indemnity. We'll see one by one very closely. Now, first basic thing, why a valuer is required, I am explaining. So now you saw two conditions. One is your underinsured properties. Another is your overinsured properties. What will happen in case of underinsured property? That means now you should properly judge this insurable value before going for a insurance. If your insurable value is 100 lakhs, you should go for a policy for 100 lakhs. If you go for less than that, it will become underinsured. If it is underinsured, what will happen? In case of loss, the company will not pay you full loss. He will give you the proportionate amount. If you go for 50% insurance, he will pay you 50%. So you are in a financial loss. In case of overinsured, what happens? It's a very simple thing. You can answer. If it is overinsured, you have to pay more premium. So you are in loss. So instead of paying, let us say 10,000 rupees, you are paying 14,000 rupees every year. So you will be in loss. So now the duty of a valuer comes now here to properly find the insurable value. And accordingly, you take the policy amount. Is that clear to you? That is the main purpose of or the work of a valuer here. So this is what I have given here. What is the role of valuers for insurance? Because this is a basic question coming to you that we are going to do valuation course. Why this insurance is there? This is a very important part, and number of times you will be required to value the property every year. Why, that also we'll discuss. If you are having a car, suppose 20 lakhs you have purchased, you would have seen the next year they will reduce the value to 18 lakhs or 15 lakhs. The next year they will reduce to 12 lakhs. There no valuer is coming. In case of building, it is opposite. Suppose today the building is 100 lakhs. After 5 years, there may be depreciation. Let us say some depreciation of 10 lakhs is there. Your value of the building is not 90 lakhs then. Because of these market conditions, that would have increased to 140 lakhs. Then you have to go for insurance for 140 lakhs in that year. Why? I have explained you the insurable value is the net value of the building at the time of loss. Suppose after 5 years there is a loss, you have to find out what is the value after 5 years, what is the market value at that time, and from that you deduct your depreciation, you deduct your foundation cost. Is that very clear? So here we have just given what is the role to insured amount. I have again given the definitions. The insured amount is called policy amount, PA. We will be denoting next time PA, policy amount. The premium for the insurance policy depends on the policy amount. It is very natural. If you are going for 100 lakhs policy, you may pay some premium of, let us say, 10,000 rupees. If you go for 200 lakhs rupees, you have to pay 18,000 or 16,000. Then insurable value. What is the definition of insurable value? This is very, very important. It is the net value of the building without foundation cost at the time of loss. What do you mean by net value? Net value means wherever net word is coming, you have to deduct something. Like net income, you deduct outgoings from gross income. Similarly here, net value means from the value of property, you deduct the depreciation. So you get the net value of the property. From that, you deduct the foundation cost at the time of loss. That is called my insurable value. Maximum time in the case study also, you will be getting find the insurable value of the property. So it will be very simple. You just calculate what is the cost of the building, deduct the depreciation, deduct the cost. You get the insurable value. Policy amount, already I have told, if it is more than the insurable value, we call that as overinsured. If it is less than that, in case of overinsured, what happens? The owner or insured has to pay more unjustified premium. This word is very important. You have to pay more unjustified premium. If the policy amount is less than the insurable value, it is called underinsured. The owner is deprived of getting the full damage amount. So this is the first summary of this one. Hence, to have a balance and to finalize the policy amount, which typically be equal to the insurable value, role of valuer is very, very important. This should be done at regular interval of time, depending on the market conditions and effective age of the building. Unlike other assets, real estate has capital appreciation over time, and hence insurable value needs revision. In other cases, it is different. In case of this property, real estate, since there is capital appreciation, as I told at the beginning, 100 lakhs today, but after 5 years, it may be 140 lakhs or 130 lakhs. So from 130 lakhs, you deduct the depreciation. It may become more than 100 lakhs. So at that time, you have to revise the insurable value, or else you will be getting less amount of claim. An underinsured building faces heavy financial penalties during a claim. As I told, you have insured for 50 lakhs. your insurable value is 100 lakhs. So 50% you have insured, underinsured. So if your loss is 20 lakhs, you will get only 10 lakhs. So you will be under financial problem. This is another next topic is laws of insurance. This is very, very important. Each word is very, very important. There are basically 6 terms we'll be using. One is called utmost good faith. Individually, we'll again see what is what. Second one is your insurable interest. Third one is indemnity. Fourth is subrogation. Fifth is contribution. Sixth is proximity cause. Very simple word. First, I will explain each.
Yeah,
Sir?
these are very, very important terms. You
Yes.
may get a short question out of these 6 terms. You may get it during your examination. Over to you, sir.
Right.
Sorry to interrupt.
Right. So very simple words. First, let us understand. Then each we again will go in deep. Utmost good faith means you should not hide anything. Suppose you have taken a building, but its foundation is weak. It has designed for 2-storied. You have constructed 5-storied. You have hidden that one. Then later stage, if the building collapses and the insurer finds that due to faulty design, he may not pay you. Similarly, the insurer has also the same thing. He should not hide so many things. There is a term called peril, we'll deal next. What all are covered in the insurance? That should be very clearly told. In life insurance also it happens. That is why the IRDA has given now free look period, 15 days. You take a policy, by chance within 15 days also you are able to know that some utmost good faith has not been done. You may cancel the policy also. What is insurable interest then? This is a very, very important word, insurable interest. You see, suppose your neighbor is having a car. Can you go for insurance for that car? Or for me, can you go for a life insurance for me? You cannot. For my building, I can go only for insurance, no other person, because the other person has no insurable interest on me or my property. But some exceptions are there. Can you think where? Suppose you have mortgaged the property to a bank for 50 lakhs. Now the bank has got an insurable interest in your property or in you for up to the extent of 50 lakhs, not more than that. The property may be 1 crore, but you have mortgaged the property for 50 lakhs. So the bank is having an insurable interest of 50 lakhs and he may go for a life insurance of yours for 50 lakhs also. Because he is now got the insurable interest. For some third parties, like that many exceptions are there, we'll discuss that in detail. But understand, insurable interest means you should have interest in that property. Then what do you mean by indemnity? Indemnity is nothing but it is a guarantee type that in case of loss, the insurer has to pay you one. Second thing is very, very important is you cannot make profit out of the loss. Many people, what they do, they got a small accident of the car, they damage still more. They will break the glass has got scratches, let us break it. So that also they will get it. That is getting some profit. Or there is a loss of 10 lakhs. You are just telling that I have got a loss of 20 lakhs and you are getting that loss. So those things to prevent, that is called indemnity. You get exactly your loss amount, not less, not more than that. A very simple language you can understand. That is called my indemnity. What is subrogation? Subrogation, number of times MCQs are coming. Subrogation means for a third party, your building got damaged. How? Let us say, I will tell a real life example here at Bhubaneswar happened. One person had constructed a building. Nearby land, another owner, he had gone for a deep excavation for constructing a raft foundation, basement, without taking proper care. So what happened? He excavated about 10 to 12 feet. This adjacent building collapsed. So the collapse, for that who is responsible? The third party is responsible. Because that second fellow, that owner, without taking protection, he excavated the dam. Now the insurer, the insurance company, will pay the loss to the insured, but he has the right to get it back from that third party. That is called subrogation. If a damage is caused by any third party, the insurer, after paying the loss to the insured, has the right to recover the amount from the third party. That is called subrogation. What is contribution then? You see, most of you would have taken 2 to 3 life insurance policy with this X company, LIC, you would have taken for 10 lakhs. From some Birla Sun Life, you would have taken from 30 lakhs, like that. Let us say you have taken insurance from 3 companies. In case of that one, what happens? If anything happens, all the 3 companies will pay you. But in case of a building, suppose I have taken for my building 3 insurance policies. I have taken in one company 30 lakhs, another company 30 lakhs, another company 60 lakhs. That means how much I have taken insurance totally? 120 lakhs I have taken. I found that my insurable value is 120 lakhs. What I did, I just distributed it. From company A, I took 30 lakhs, B, I took 30 lakhs, C, I took 60 lakhs. Now, suppose there is a loss of, let us say, 60 lakhs. What is that? I have taken policy, one is 30, from another 30, another 60. So totally how much I have got? 120 lakhs of policy I have got. Now I got a loss of 60 lakhs. What will happen? This will be contributed to the 3 companies in that proportion. That means 1:1:2 proportion that will be distributed. So this fellow will pay 15 lakhs, this fellow will pay 15 lakhs, this fellow will pay 30 lakhs. So you got your 60 lakhs. That is called contribution. Is that clear? The last one, let us see, this is another very, very important point, proximity cause. What do you mean by proximate? In your mobile also, you have proximity you have to made on. When you take nearer to your ear, that will be, the screen is off. Have you noticed? Your screen will be on. When you take nearer to your ear, the screen will be off. During talking, the screen is off. That is called proximity you have entered. Proximity means nearer, very closer. Now, sometimes what happens, when you take an insurance, you would have taken for some cause. Let us say for fire you would have taken. A standard fire insurance policy you have taken. That covers only fire and other, but does not cover earthquake, let us say. Now suppose a building got fire, not due to direct fire, but due to earthquake. That example I will show you in detail later. So the cause of that fire is not actually fire, it is earthquake. The company will not pay you for that loss. He will check what is the proximity cause. Why that damage happened. You have taken policy for fire, but the fire was due to earthquake. So you will not get that loss amount. Is that clear? So these 6 points, if you have understood properly, 50% of insurance chapter is over. Now let us see very fast. We'll just go through this. Whatever I have told, just we are going to see in theory basis. What is utmost good faith? It is duty of proposer. Proposer means the insured, the building owner. Duty of the proposer to disclose all information about the asset. Like I told, your foundation design is proper or not. Any other problem is there. You are going to store some explosives in that or what. All those things. Insurer cannot bias or mislead the buyer. This happens in most of the insurance cases. The insurer makes bias. Sir, you do it. If anything happens, you will get it. But he will not tell that, sir, if earthquake, due to earthquake it happens, you will not get it. He will not tell. He will tell, no, sir, every claim you will get it. That is the biasing or misleading. here, that is why in insurance there is a proverb, let the buyer beware. Buyer has to go through all documents. For that, they give 15 days free look period. You get all these legal rules, you go through that one, then only you enter the insurance. Next one is insurable interest. This is a very important, already we have discussed. Simply we are going to read out now. It is, there should be valid reason to insure an asset. That means you should have an insurable interest. The neighbor cannot insure for your property because he has no valid reason. Owner suffers direct financial loss. He is getting a direct financial loss, then only he can go for insurance. Without insurable interest, contract is void. That means if you don't have any insurable interest, but you have entered the insurance, if the insurer comes to know later, he need not pay you because the contract itself will become void. Ownership or joint ownership. If you are an owner,
sir,
you can go
sir,
for insurance.
Sir, if you permit, मैं थोड़ा सा इसको explain कर दूं without insurable interest.
Okay, sir.
या फ्रेंड्स देखिए, अगर आपको इंश्योरेंस लेना चाहते हैं, लेट इट बी, मैं इंश्योरेंस लेना चाहता हूं, मैं अपना ले सकता हूं, अपनी कार का ले सकता हूं, अपने किसी फैमिली मेंबर का ले सकता हूं, मेरा बेटा लेना चाहता है इंश्योरेंस, वो अपने फादर का ले सकता है, अपने मदर के बारे में ले सकता है, अपने किसी प्रॉपर्टी के बारे में ले सकता है। लेकिन क्या आप अपने पड़ोसी के घर का इंश्योरेंस ले सकते हैं? क्या आप अपने पड़ोसी के फैमिली के किसी मेंबर का इंश्योरेंस ले सकते हैं? क्या आप उसकी प्रॉपर्टी का इंश्योरेंस ले सकते हैं? दैट इज कॉल्ड द इंश्योरेबल इंटरेस्ट। आपका उस पर्टिकुलर उसमें इंटरेस्ट वैलिड है या नहीं है। अगर थर्ड पर्सन का आप कोई इंश्योरेंस लेते हैं तो उसमें आपका इंटरेस्ट क्या है, वो जब तक वैलिड नहीं होगा, जब तक आप उसका इंटरेस्ट वैलिड नहीं होगा, जब तक आप उसको इंश्योरेंस नहीं ले सकते। मैं ठीक बोल रहा हूं सर?
हाँ सर, पूरा करेक्ट
जी, ओके सर, प्लीज कंटिन्यू।
Yeah. Then I had told you bank, in case of mortgage property, to the extent of loan. You see, this word is very important. You have taken 50 lakhs loan, the bank can go for insurance of 50 lakhs. He has the insurable interest of 50 lakhs, though the property is 100 lakhs. Third party liability in addition to property. That is, suppose during construction you have taken insurance, and some material fell down or a labor fell down from the top of the roof. There also the loss will be paid. That is called my third party liability. Then interest on life of the debtor. This is another important. Now in case of property insurance, also on the life of a debtor, that is who has taken the loan, he can take, or a guarantor also, up to the extent of loan amount. That is also insurable interest. Now indemnity. Third one is indemnity. This is assurance or guarantee given by the insurer to make payment of, again very, very important, least of actual loss or sum insured. Whichever is least, that is indemnity clause. MCQ is coming. In case of a loss of this much, the insurer pays this. Under what law? That is law of indemnity. In case of underinsurance, again the word came. Underinsurance, already I have told you. In case of underinsurance, law of average will apply. This law of average we'll see in case studies also. Law of average means you have taken 50% insurance, you will pay 50%. If you take 70% of the insurable value, you will get 70%. That is called my law of average. Generally, in case of damage, this is another important point. Generally, in case of damage, salvage value is nil. Generally, what happens when the building got fired and all, even salvage value may become nil. So, to avoid that confusion, in insurance, salvage value is generally treated as nil. And if any salvage is there, that will become the property of the insurer, the company. A good example I will tell, actually my car, I had got long back, my bonnet got damaged. Those people replaced my bonnet, but took away the old bonnet. They didn't deduct the amount. That is scrap value. So that becomes the property of the insurer. Then another important term now here, this also, these case studies are coming, excess and franchises. These are the deductibles. What is excess or franchises? Just understand little, then in case study again we will see in detail. Sometimes what happens, there is some processing charges. When you go for insurance and you made a claim, the insurance company will send a surveyor, a valuer, they will value it, what is the loss. All these processes, they will have some expenditure. So in the clause, they will mention, let us say, this policy has excess of 10,000. That means the deductible, if you got a loss of 1 lakh, the company will pay you only 90,000. That 10,000 what excess was there in the policy, that will be deducted. So in the case study, you will ask, if there is a clause of 10,000 excess in the policy, what is the claim payable? So excess means don't add it. You have to deduct it. Then next is subrogation. This also we have discussed. Insurer, after setting the claim, can claim the loss from the third party who is responsible for the loss. As I told, your building collapsed due to the negligence of the neighbor. So the insurance company will claim from the neighbor. Or a contractor is working, due to his negligence, some damage occurred. So the insurance company has the right to collect that amount from the contractor. That is called subrogation. So subrogation is the right of an insurance company to step into the shoes. This is a proverb you are using. This was asked in one of the MCQs also. Steps of the insured building owner after settling a claim. It allows the insurer to legally collect the amount from the third party that actually caused the structural loss or damage to recover the amount paid out of in the claim. Contribution. This also we have discussed. When 2 or more policies are taken for the same asset, for the same perils. Perils means the nature of damage. For what that damage occurred, that we will again see later. Perils. Claims shall be contributed by the insurers proportionate to the insured amount. That one example also I had told you, 30, 30, 60, they have taken totally 120 lakhs. There is a loss of 60 lakhs. Then this fellow will pay 15, 15, 30 in that same proportion. Here also I have given an example. If 2 policies, 100 lakhs and 50 lakhs are taken and the loss is 30 lakhs, then what will happen? Total is 150 lakhs you have taken. So 1/5 has come. So each company will pay 1/5. The 100 lakhs you have made, he will pay you 20, 1/5. The 50 you have taken, he will also pay you 1/5, 10 lakhs. You get 30 lakhs. But companies will contribute. That is called contribution. Proximity cause. This we have discussed. That is the exact cause of loss. Why that loss happened? In case loss occurs due to multiple perils, the proximate or nearest or closest cause should be taken into consideration to decide the liability of the insurer. This I have given a good example here. Principle of proximity cause. This is called causa proxima. Sometimes they are introducing these German words also. A fundamental rule used to determine the actual cause of the loss when a series of events take place. Here, suppose I have taken one example. You have to, let us say, you see here. You have taken a standard fire and special perils. This is called SFSP insurance. We'll see in type of insurance also this one. Here, let us say fire and explosion is covered, but earthquake is not covered. Now there is a event, series of events you see here. We have told that first event is you got a severe earthquake. Due to that earthquake, one underground municipal gas main line burst near your building. That gas seeps into your basement of your building. Then one automatic electrical switch in the basement sparks. Now this building is completely burnt. Now whether you will get the insurance or not. You have taken a insurance for fire and explosion. But that does not cover earthquake. There is exclusion. So here we have to see what is the proximate cause. The main cause is earthquake, not fire. So you will not get that insurance amount. Insurance verdict is claim denied. Why? The building owner files a claim stating that the building was destroyed by fire and explosion, which are clearly covered under the policy. However, after an investigation, the insurance surveyor denies the claim. Why? You see, here I have given in a reverse way. If you come, first earthquake took place. He went in the different direction. Okay, your building is destroyed. Due to what? Due to fire and explosion. Why this fire and explosion occurred? Due to gas leak. Why gas leak occurred? Due to broken pipe. Why that pipe was broken? Due to earthquake. So your claim will not be given. Are you able to follow? The proximate cause means what is the closest cause due to which the damage occurred. Now let's see a reverse one so that you will understand still better. Counter example. Now suppose the earthquake occurred. It hit your building, but it did not collapse or it did not catch fire immediately. After 2 to 3 weeks, let us say some electrical short circuit came in your kitchen and it got fired. Now fire breaks out and damages the building. Now the claim will be approved. Because due to earthquake, that fire didn't occur at that time. Later, due to some fire in the kitchen, it occurred. So in this case, the insured will be paid. In some textbooks, if you see prescribed by IBBI and all, they give some health example. One fellow was going in a rainy season in a motorcycle. He fell down, got accident, but he didn't get much damage. But due to that rain, and since he was fell down for a long time, he caught fever. Then he got pneumonia. Then he died. So what is the proximate cause now? It is not the accident. It is due to that rain. He was drowned for a long time. He got that fever and he died in fever. So like that, in a building example is very clear to you. This you have to take care. Now, what are the next topic he has given in your course syllabus? What is the duty of the insurer and the insured? These are very simple things. We'll just go. If you get any confusion, you can ask me again. First one is the rights, duties, and obligation of insured. See, obligation to pay the premium to purchase the insurance policy, examine the policy, and to decide the exercise of free look period allowed in the policy. This is for the insured, that is who is taking the policy, the owner of the building. Duty to observe utmost good faith while purchasing the policy. That is, it should not misrepresent. To act, behave as if uninsured. You see, this is a very critical word. To act, behave as if uninsured and take all responsible steps. Are you able to follow that line? Suppose you have taken a car insurance. That does not mean that you will fully drink and drive. I have taken insurance. If any damage is there, insurance is going to pay. You should not think that way. You should think that you have not insured. That is what he is telling. To act, behave as if uninsured. That is, you maintain your property thinking that no insurance has been done. And take all reasonable steps to protect the subject matter. If it is discovered that the insured is behaving recklessly or in a way that could invite the loss or increase the loss or liability, the claim will be prejudiced. It will not be paid. Duty to notify the loss or claim to the insurer. So whenever there is loss, you should not think that the insurer will come and pay you. You have to intimate the loss immediately with the reason. Why it happened, what is the claim, and you have to go for a claim. Is that clear? Then notify all material facts concerning to the incident and the loss underlying claim. To provide proof of loss and required documents. sometimes photographs, everything you have to give. The duty to cooperate with the insurer and the surveyor, you have to cooperate them. The duty requiring the insurer's consent for incurring the defense cost. That is for defense purpose, if you are giving any, you have to defend, let us say. At that time, some amount is spent, that you have to pay. In case of property damage claim, the duty to take all reasonable and necessary steps to prevent further damage after the loss. This is another important point. Suppose a small example I will give. Your TV got burnt due to lightning. Okay, anyhow, lightning was covered in the peril. So the company will give you a new TV. But after getting that, you take care that next time lightning is coming, you have to switch off that TV. You have to remove, unplug that one. So similar way, whenever you got some damage, you take precaution. Suppose due to faulty wiring, spark came and your building got fired. Then after getting repaired, you repair by a licensed holder. That who is a proper having license of electric. So that further spark will not come. That is that point. Duty and obligation to protect rights of subrogation. What is subrogation you have seen? From third party he has to collect. So when the insured has a right of recovery from the third party who is responsible for the loss, the insured has to take all steps to protect the right of recovery and subrogate his right to the insurance company as per the policy condition and common law. That means you should not prevent him. Sometimes they will think, I will take the amount from the insurer. Suppose somebody hits your car. You take amount from the insurance company. Again, that person also you collect. You cannot collect. You help that the insurance company is collecting the amount from that person. Right of indemnification. That is right to receive the claim as per the terms of coverage, limitation and compliance of the policy. That is indemnity clause. Okay. Then what are for same thing for insurer? It is the duty of the insurer to ensure that interest of the insurance policy holders is protected. Insurer distribution channels and other regulatory entities fulfill the obligations towards policy holders and have in place standard procedures and best practices in sales, services of insurance policies. Policyholder-centric governance by insurer with emphasis on grievance redressal. So if you are not paying also any grievance that the person is telling the insured, you have to take care of that one. If not, again, it will go to arbitration. If arbitration fails, it will go to court of law also, because it is a contract. Duty to defend the insured, this is also same. Duty to gain the insured cooperation, it is the duty of the insured to maintain good relationship with the insured. Each party must be able to rely on one another and abide by the guidelines of their end. Whatever part you are having the law, from insured side he has to obey, from insured side also he has to obey. The duties of good faith and fair dealing. The insurer owes a duty to deal fairly and in good faith with the insured. The duty at the time of entering contract is to provide all details of coverage, the time insurance policy, fair dealing and supporting at the time of claim. The duty to settle claims and pay benefits. Insurer should be careful to make settlement offers based on a realistic evaluation of the exposure. Once the insured contingency accident happens and the damages have been reviewed, it is found that the claim qualifies based on the benefits, time period and exclusion given in the policy. It is the duty of the insurer to pay for it. It's very simple. Whatever is the condition is there, if any loss happens, the insurer has to pay it. In case the claim is not admissible, it is the duty of the insurer to inform the insured giving reasons, like the proximity cause, or any other cause he can give. Sometimes what happens, due to wear and tear, some losses are there. We have put some iron grills in, so after 20 years, they are fully damaged. You cannot claim for insurance because anything happens due to sudden impact. They are only any accidental. There only you will get the insurance claim. Privacy protection. Generally, insurances are very private things. They cannot say what amount of loss was occurred, how much they paid to other party. It is the duty of insurer to adopt all required measures for the assessment of the risk and fixing the premium. The premium should be as per the associated risk. Reserve of our policy, it is the duty of the insurance company to set aside. That is, the insurance company, whenever you pay the premium, a portion of that will go for his expenses, staff salary and maintenance. A portion he has to keep for the insurance. For that also one story is there. If time permits, at the end I will discuss that one again. Now, next very, very important chapter, different types of fire insurance policies. Because the case studies I have to deal very little detail, so we'll just go a little fast. First one is agreed value policy. What is agreed value policy? In this case, what happens? At the beginning of taking the policy, both the insured and the insurer fix an amount. If any loss is there, I will pay you 10 lakhs. It is a agreed value policy. In which case, it does not depend on the market value. It may be less than market value, it may be more than market value. Here, that indemnity clause does not apply. Indemnity what says? Insurance company will not pay you more than the loss at that market value. Here, that does not work. In which cases generally it happens? In some art which has no value. You cannot judge a art, this will be 10 rupees or 20 rupees or 1 lakh rupees. Similarly, jewelry, paintings, monuments, in those cases, as you will not be able to exactly find non-marketable properties, you can say. So, in those cases, you have to go for a fixed sum, where the insured and the insurer both agree that, okay, if this art is lost, you will get 50,000. So, if the art is lost, directly 50,000 you will pay. Then specific policy. This is more or less same as agreed, but there it is for the monumental type. Here what happens? Here also, irrespective of the market value, a amount is fixed. Suppose the market value is 1.2 crores of a property. But you mention there that in case of any total loss is there, you will get 1 crore. So in that case, you will get only 1 crore rupees. Though the market value is more, then you will get 1 crore if the loss is 1 crore. Okay. Even underinsured also you will get that much. You see, suppose today the property value is 1 crore. After 10 years, your property became 1.4 crores. Then it became underinsured. In general policy, you will not get full amount of 1 crore if the loss is there. But in this case, you will get 1 crore. That is called specific policy. Average policy. This one is another very, very important item. These are mainly for your underinsured policies. What is underinsured? Already we have seen. You would have by hearted by this time. Your value of the property, insurable value, let us say 100, but you have taken a policy of 50 lakhs. That means you are underinsured. Because your value of the property is 100, but you have taken a policy of 50. So 50% only you will get. That ratio, that policy amount by the insurable value. Policy amount you took 50 lakhs, but insurable value was 100 lakhs. So the ratio became 0.5, 50 by 100. That 0.5 is called underinsurance factor or underinsurance quotient or underinsurance value percentage. You can say. So in that clause is called average clause. This paying of 50% of the loss is called average clause. And if the average clause is there, the policy automatically become an average policy. And in most of the standard fire policy, this average clause is there. So I have given an example, same type. If you have a 10 crores of a building is there, but you have taken an insurance of only 6 crores. That means what happened? You have taken only 60%. Your damage came 2 crores. Then you will get 60% of the loss. 60% of 2 crores, 1.2 crores only you will get. That is called your average policy. Because the building was only insured up to 60% of its true value, the insurer will apply the average clause and pay out only 60%. That is only 1.2 crores he will pay you. Remaining 80 lakhs you have to pay from your pocket. That is where the role of valuer comes. The role of valuer is to find out the exact market value during the loss and guide you or advise you regarding what should be your policy amount. Here, if you would have taken a policy amount for 1.2 crores, he would have got full 1.2 crores. Then floating policy. These are mainly for goods, can also be used for building. Suppose a person is having 2 to 3 buildings at different locations. He took a single policy, or he is having storage garden for his goods, let us say clothes. In garden A, he has kept some goods, B, he has kept some goods, C, he has kept some goods. All together, he can take a single policy that is called floating policy. That is at different place, they have the metric. Comprehensive policy. Comprehensive for motorcycle, car also you go for comprehensive policy. That is all in one. All risks are covered in comprehensive policy. Consequential loss policy. This is another important term. Consequential loss policy. What do we mean by that? Generally, you see, suppose you are running a business and a loss occurred, a damage occurred. The company will pay you the loss, no problem. But to rebuild that one, you may take some 3 to 4 months. During that 3 to 4 months, your business will have loss. Suppose you have an office building. That office building was collapsed. Again, you have to reconstruct the office building. So during that time, you got some loss of your business. So that loss portion also the company will pay if you have taken a consequential loss policy. Is that clear? Another, this is very important term. You will be thinking that I am telling everyone is very important, but gradually the importance is going on increasing. This is called reinstatement policy. You would have heard the word reinstatement. Reinstatement, that is to bring to new condition as it was in the old condition. That is earlier. How, in what condition that building was there, to the same condition you have to bring. In cars also, you are going for zero depreciation policy. Previously, what happened, if you take an ordinary policy, fiber damage, the company will not pay. Glass damage, the company will not pay. But if you go for a zero depreciation policy, for everything they will pay. For fiber also they will pay. Similarly, for building, this reinstatement policy is called zero depreciation policy. That means what? No depreciation is allowed in this case. See, earlier what we told, you have taken a building, I have constructed for 100 lakhs. After 10 years, some depreciation of 10 lakhs is there. So your value of the property became 90 lakhs. So your insurable value became 90 lakhs. But in case of reinstatement policy, your insurable value itself will be 100 lakhs. No 90 lakhs. No depreciation. So whenever you see the word reinstatement, immediately you think that there is no depreciation. The problem became more simple. In general case, what we do, how to calculate insurable value? You find out today's cost, deduct depreciation, deduct foundation cost. Once you see reinstatement policy, today's cost minus foundation. No depreciation is deducted. I think it is very clear. But there is one restriction. In reinstatement policy, the insurance company will pay you the full amount to rebuild as it was in the previous to damage condition. Prior to damage condition, you bring the building, he will give. But in general case, what happens? Suppose a building is there and that got damaged. the company paid full 100 lakhs. But you told that again, why you will construct? This is an earthquake zone. Again, earthquake will come. It will fail. That 100 lakhs I will invest somewhere else. If you don't reconstruct the building, this reinstatement policy will lapse. It will become again an ordinary policy. He will deduct depreciation, then he will pay you. Please understand the difference. 100 lakhs was the property. Depreciation is, let us say, 20 lakhs. In ordinary standard fire insurance, you will insure for only 80 lakhs. And the damage, if fully damaged, company will give you 80 lakhs. If you introduce reinstatement policy, your insurable value will be 100 lakhs, not 80. If damage occurred, full damage, company will pay you 100, provided you reconstruct it. That does not mean that you will reconstruct after 5 years. You have to reconstruct it within 12 months from the damage. You see, reinstatement must typically begin and be completed within a reasonable time frame, usually 12 months from the date of damage, for the clause to apply fully. Or else he will again deduct the depreciation and pay you. Another word they have introduced in your course, beneficial clauses and restrictive clauses. This already little we have discussed, but as the course gives particularly these two words, I have again taken these two. What is beneficial clause? Actually, which benefits you, the insured. That is beneficial clause. What is restrictive clause? Which restricts the insured. They are called restrictive clauses. Let us see first beneficial clauses. This expands coverage, which say these clauses provide essential protection for the homeowner, ensuring that inflation, special legal scenarios, and modern rebuilding costs are accounted for. As earlier also in classes you would have studied. Earlier, let us say in stone masonry you have done. Now brick masonry has come. You can go for a brick masonry also. Or mosaic tiles you have done. Now you can go for a marble tile or ceramic tile. Here one more point will come that we will see, what is called betterment clause. Sometimes you have to pay. If that clause is not there, that difference you have to pay. Then reinstatement clause, already we studied now. There is no depreciation. That is also a beneficial clause to the insured, because there will be no depreciation, entire value you will get it. When it happens, when the age is very high, suppose a building is 60 years life, already 50 years has gone. So the depreciation will be very high. But in case of reinstatement clause is there, you will get the full amount. Then escalation clause. Generally what happens, as the market is going on varying, the inflation, due to inflation, the cost is going on increasing. So automatically in health insurance, this is there. This year you make a health insurance for 1 lakh. You don't claim. Next year automatically it will become 1.2. Next year it will become 1.4, like that. Here also typically around 10% every year, the policy year, it will be increased. That is called my escalation clause. Because of this material increase, they increase the value of the property automatically. Then another interesting thing is debris removal clause. Suppose your building collapsed. No doubt, whatever the portion or damage you got, the insurance company will pay you. But whatever the removal of the debris, that also will cost you. Suppose a building is some 1 crore, you may incur about 1 lakh. Then that 1 lakh who will pay? So if you have that beneficial clauses, this debris removal also the company will pay. Of course, there is some limitation. In the clause, you have to read that one. They generally it is around 1%. More than 1% means you have to pay add-on cost. 1% is generally included. That is asked in MCQs. Suppose you tell that no, I want 3%, then extra premium you have to pay. Is that clear? For removal of the debris. Then what are the restrictive clauses? Main restrictive clause is your underinsurance. Once your policy is underinsured, then average clause will be applied. That is proportionate amount only you will get. This already we have discussed. Then maintenance and wear and tear exclusion. This I have told also. General wear and tear the company will not pay. What it does explicitly excludes damage caused by gradual deterioration, rust, corrosion, wet or dry rot, or inherent defects in the building material. It highlights the distinction between a sudden accidental event. In case of sudden accidental event, you will get the loss. But the gradual loss, you will not get. Okay? Then depreciation clause. That is on indemnity basis policies. If the policy is not written on a reinstatement basis, this already we have discussed. General policies, you will have depreciation clause. They will allow depreciation. So after 10-year age is there. For 10 years, you calculate the depreciation. The net present value, over that the loss will be paid. If reinstatement is there, then you will not apply this clause. This is what in a tabular form I have given. What is the beneficial clause? Reinstatement is there. Pays for brand new replacement, zero depreciation. Another beneficial is escalation. Factors in midterm inflation of construction materials automatically. Restrictive clause, average clause, penalizes the owner proportionally if the property is underinsured. Then wear and tear exclusion. He will not pay for your negligence or the maintenance. You have not maintained properly, your grills got rusted. For that, the company will not pay you. Is that clearly understandable, or I am a bit fast, or what? Can anyone give me?
It's okay, sir. It's okay.
Okay. Thank you, sir. Thank you. So these are the basic things of your beneficial and restrictive clauses. Now, the next item is the type of clause. In that, we'll be discussing little in detail the main topic, standard fire and special peril insurance, SFFP. This is the standard insurance. The other ones are special categories. So here what happens, if a policy with fire insurance along with perils due to acts of God. What is acts of God? Which is not in our hand. Like lightning, earthquake, floods, storms, landslides. What is other than this social perils? Riots, strikes, malicious damage. Some strike occurred, due to that some loss happened. That is coming under social peril. It is not act of God. Okay. So these are the perils due to acts of God. It includes. Then the losses and expenses not covered under SPR, which is not covered. 5% of each claim subject to a minimum of 10,000. You see, you are making a claim of, let us say, only 1 lakh. In that, he will not deduct you 10,000. 5% of each claim, 10,000 he will deduct. He will not deduct only 5,000. He will deduct 10,000. Suppose 1 crore is there. That means 5 lakhs is coming. So he will deduct accordingly this 5%. Minimum 10,000 and generally 5%. This has to be in the clause. Without clause, they will not charge you. Resulting from lightning. For what? Not for all perils. Peril means the matter due to which loss occurred. The item due to which loss occurred. So, read this line carefully again. 5% of each claim subject to minimum of 10,000 rupees resulting from lightning, landslide or rock slides, etc., which are acts of God. In other perils, it is directly 10,000. 10,000 in respect of all other perils. Next one is, whenever you got loss, suppose your building got damaged, you have to reconstruct it. So at that time, you may contact one architect, you have to contact an engineer, again he has to give layout, again you have to build, he has to supervise. All these things, for that 3 to 5% of claim amount is kept in the clause. Suppose it is mentioned 3%, then 3% also the company will pay you. Removal of debris, already discussed, of 1% of claim amount, not policy amount. 1% of claim amount. We'll do a case study there, you will see that. Another very interesting point here, this is also asked MCQ. If building is insured, if a building which has been insured remains unoccupied for a period of more than 30 days, that is, you have insured a building, but you have kept it closed for more than 30 days, then the coverage may lapse. Because there may be some damages due to vandalism or unnoticed leakage or cracks, etc. So this is also a condition in the SFFP. Is that understood? So your property should be utilized always. What is fire insurance covers? This already we have discussed. It is again written here. So let me skip out, but only the first paragraph, second paragraph you would read. The standard fire and special perils, because some MCQs are coming, he will give ABCD which are covered. Generally, it covers the perils like fire, lightning, explosion, implosion, aircraft damage, riot, strike, malicious damage, storm, cyclone, typhoon, tempest, hurricane, tornado, flood and inundation, landslide, including rock slide, bursting, etc. These things you can go through. Okay. For all these things, the perils are covered. Then next item, the last item, of course, is your preparation of claim. So how the claim is prepared. The processing and settlement of claims is one of the most important and primary functions of an insurance organization. For proper settlement of claims, it is necessary to have a sound base of knowledge of general law of contract as applicable to insurance. Why? In that insurance contract, actually you have to read which all perils are covered. Accordingly, only the loss will be calculated. The settlement of claims involves examination of the loss in relation to the coverage under the policy. Okay. The burden of proof, or to use the legal expression, the onus of proof that the loss is within the scope of the policy is upon the insured. Generally, the insurer, he will not want to pay for all. So it is the duty to prove for the insured that these losses are covered by this and you pay for that one. That is what it is meaning. The second aspect to be decided is whether the insured has complied with policy conditions, that is immediate notification of loss. Loss happened, you inform after 6 months, he will not pay. Immediately you have to inform about the loss, the extent of loss you have to tell, okay, and you have to help him in assessing the loss. The third aspect relates to the examination of the observance of utmost good faith, that is duty to make measures for minimizing the loss. The fourth aspect concerns the determination of the amount payable. The amount of loss depends on the following: the extent of the insured insurable interest in the property affected, the value of salvage, application of pro rata average, pro rata means miscellaneous expenses, deduction for any excess or franchisee, that is like 10,000 excess is there, that will be deducted. Application of contribution and subrogation. Contribution means you have taken 3 policies, it will be equally divided, or in the proportion of the policy amount, it will be decided. Then subrogation also, from the third party, you have to collect it. The fifth aspect results in resolution of disagreement between, that is, it is for dispute. Suppose the company told that your loss is only 20 lakhs, but you are telling, no, I have suffered a loss of 40 lakhs. Then the matter may go to arbitration, a third party, independent party. He will decide. If you are agreeing both the parties that, let us say 25 lakhs you have agreed, then he will pay it. Or else you have to go to court of law. The final aspect deals with recovery from the third party, that is subrogation. Okay. Then claim settlement, the same thing again, a point wise I have written. Policy conditions usually provide that the loss to be intimated to the insured immediately so that the investigation can be made easily. Under certain type of policies, Suppose theft is there. You have gone for a policy with materials inside and some theft is there. So at that time, you have to inform to the police also. Similarly, suppose rail transit, some problem came, you have to inform the railways also. On receipt of intimation of loss or damage, insurer what he does? The policy, first he will check the policy is in force. It is not lapsed. So first he will check that your premium you have paid regularly and it is in force at the time of loss. The loss or damage is by a peril insured by the policy. As in the beginning we told, suppose earthquake is not covered and the damage came due to earthquake, then he will not pay you. The subject matter affected by the loss is the same as the insured and under the policy. It is there for that it is insured and it is in the policy. Notice of loss has been received without undue delay. Some people keep a term of 7 days, some item 30 days. It is in the clause that you have to intimate within this time period. So if you are intimating within that time period only, the claim will be paid. Investigation and assessment of loss. Surveyor will carry out investigation for following property damage. What is the most probable cause of damage? He will first find out proximate cause. If the property will be repaired, this is another important point. If the property will be repaired, replaced or combined, no temporary repairs will be permitted. That is, the insurance company will not pay twice. He will tell that, okay, sir, till you are paying me the amount, first I will temporarily repair it and stay there. For that temporary, he will not pay you because he is going to pay you for the permanent damage. Surveyor will assess the cost of repair, replacement and give final assessment. Okay, so this is the survey report, may give preliminary, interim or final report considering status of claim progress. Surveyor may give adjustment of loss in terms of policy conditions. It will include salvage, underinsurance, deductibles, parts not payable. That is, he found out total loss. From that, he will find out which all are not payable as per the policy term. Then he will find out the net amount of claim. Insured will submit claim form, photographs, and estimate bills of repairs to the surveyors to facilitate the procedure of claim. Insurer will offer claim settlement along with claim discharge voucher. Okay, this is how the payment will be made. Then this arbitration is there. If you have any dispute, you have to go for arbitration. And suppose the arbitration also you are not satisfied, then you can go to court of law, but within 12 months. Then salvage. Salvage is, the last at the end, whatever the scraps are remaining, those things, its value is your salvage. That is actually the own property of the insurer. He will take it. In some cases, what they do, they deduct that amount also and leave that salvage to you. Then recoveries, subrogation clause. That is, any damage is there due to third party. After paying the loss, he will collect it from the third party, recover. Then loss minimization. This is a suggestion type item. That is, once the loss is there, the surveyor will go, he will check all the loss, he will find out the loss will be paid to you, but he will find out why that damage occurred, so that next time that loss will not be there. So that loss minimization also the report will give, that due to such and such thing this happened, it should not happen. For example, he may suggest that in the electrical wiring, you should put sufficient number of MCBs, or the capacity of the MCBs are not sufficient for which it triggered fire. So those things he will mention that you have to take care in future. Then another item is that reinsurance. Can anybody think what is reinsurance? Generally what happens, suppose an insurance company is there. He has taken some 50 insurance, 50 building, he has taken insurance. Just like bank and RBI. So this insurance fellow, he may not have that capacity to control that 50. Then what he will do? He will again go for a reinsurance with a bigger company, international company. He will tell, I have taken 50 buildings for this much insurance. You have paid premium to him, let us say 1 lakh. He may give them some 60,000 and make that insurance, divert that insurance to them. maybe certain percentage. So if a loss is occurring, he may pay 60,000, the reinsurer will pay 40,000 through the insurer. Is that clear? That is reinsurance. I have taken loan from you. I don't have sufficient money. Again, I have taken loan from other. I have given loan to you, but I don't have sufficient money. So I have also taken loan from other, like bank. He is giving loan to you. Bank is taking loan again from RBI. So he is taking a re-loan, we can say, by keeping your document. So similar type this one. Role of technical depreciation, I think, sir, I will skip out because already technical depreciation and this obsolescence have been taught. If time permits, again, I will come because time is short. Role of obsolescence also you have studied. That is, the things becomes obsolete, old. So to replace with new, we are doing this. This is what a tabular form I have given. You can go through very clearly. It is written. What is technical obsolescence and economical, all those things. This is another item I wanted to discuss because it is in the course. The principle of betterment. This also I have told already. Suppose your building got damaged and you have claimed for a rebuilding it. Suppose in the old building you had mosaic tiles, but nowadays nobody is going for mosaic tiles. So what you do, you upgrade it. You go for ceramic tiles or marble. So at that time, if a betterment clause is there in your policy, the difference amount they will deduct from the claim and pay you. You tell with marble I am incurring this much of expenditure. So for that betterment, that is from the mosaic to marble, that expenditure they will deduct from you. Okay. So if an old depreciated machine or obsolete building they are replaced with a new modern alternative under a claim, not of the same type, the insured receives an upgraded asset. This is called betterment. In a loss assessment, the cost equivalent to this betterment or advancement is deducted from the claim settlement because insurance cannot be a source of profit. Sometimes I got a TV like that. My TV got burnt, but at that time that model was not there. The company gave me the next model, free of cost. But sometimes that betterment they will charge you. Sir, this model is not available. This model is 50,000. Next model is 60,000. So 10,000 you give, we'll give it. That is called betterment. Okay, so lastly, the summary for valuers. While an accountant views depreciation as a tax saving or fundamental allocation, fund allocation entry, an IBBI registered valuer in insurance views depreciation and obsolescence as measurable metrics of physical, technological, and economic decline. They are vital to ensure the sum insured matches reality and that the principle of indemnity held perfectly during disaster. What is the basic meaning of this is, while calculating for insurance purpose, you cannot take the book value. Book value, what is that one? Historical cost. From that you go on deducting the depreciation. That will not work in case of insurance. You have to take the present market value. From that you deduct the depreciation. Now we'll go for case studies. Now the case studies are very, very simple and very interesting. Kindly listen very carefully. If one example we are solving also very calmly, you can understand all the other case studies. First of all, the steps we will note down. I am giving one by one steps. First thing in this step is you have to find the insurable value. First step is insurable value. What is insurable value? IP. We have just read in the theory part that it is nothing but the net present value during the time of loss, at the time of loss. How to find out this one? This is very simple. You find out the cost of this replacement cost of the property or building. From that, you deduct the depreciation. From that, you deduct the foundation cost. Is that clear? First step is you find out the insurable value, which is nothing but the replacement cost minus depreciation minus foundation cost. How to find out this replacement cost? You have already studied cost approach. In the cost approach, whatever procedure you have taken, the same thing it will be. Okay. So how to find out this replacement cost, you have to, 1 minute. So to find out the replacement cost, you have, generally we use two methods here. One is your flat rate method or the plinth area rate method. Suppose your building is having 1,000 square feet of area and the rate today is, let us say, 2,000 rupees per square feet. Then the cost, replacement cost will become this 1,000 into 2,000. So this is 20 lakhs. Is that clear? This is what we are doing in the cost approach. So this is called plinth area rate basis. And another item is there, wherein what we do, just we go for this cost index method. So cost index method also you have calculated. Sometimes the examiner may give you cost index. That is, what is cost index? Let us say in 2010, you have constructed the building. And in 2010, your building costed 100 lakhs. Now you are in 2026 where the loss happened. So now I want to find out what is my cost in 2026. For that you have charts. The cost index, let us say in 2010 is 150. This is a rough example I am giving. And in 2026, the cost index is, let us say, 1,200. What do you mean by this? In 2010, which was costing you 150 rupees, today it is costing 1,200. That means in 2010, 1 rupee will be 1,200 divided by 150. So if it would have been 100 lakhs, the cost of construction at that time, today it will be 100 into this factor. 100 into 1,200 by 150. It is very simple. That is, it is 100 lakhs when the cost index was 150. When the cost index is 1,200, what is the value? So 100 by 150 into 1,200. So using this method, you find out first the cost. This is what I have again written, go through now. Find replacement cost at the time of loss. This word is very, very important. Always I am telling. Find replacement cost at the time of loss. Either you can go for flat rate method, plinth area into present rate, or cost index method. You can find out cost in base year into cost index of current by cost index of base year. Then find the next item is your depreciation. As you know, depreciation we calculate by three methods generally. One is your straight line method, SLM, or linear method we call. Second one is your constant percentage method. Third one is your sinking fund method. Unless given, you go by straight line method. Other methods, you know, if the examiner is particularly telling you go by this method, then use that method. So in straight line method, you know that what is depreciation percentage formula? Age upon life into 100 minus salvage value. So find out the depreciation percentage, then you find the depreciated cost directly. Suppose 30% came as depreciation percentage, that means depreciated value of the building is 70%. That is very simple. Or else you have to find out the depreciation, then you have to deduct, it takes time. So find the depreciated replacement cost here using replacement cost minus depreciation. Then finally find the insurable value. Insurable value is depreciated replacement cost minus foundation cost. Is that clear? So first step in this is you find out what is the insurable value. Okay. Now the second step is very, very important. Here what happens, the second step, if you come, here you have a policy amount and now you have got insurable value. In an example also side by side I will tell you. Suppose I got my insurance value as 100 and you have taken a policy of, let us say, 110. So second step now comes, compare policy amount and insurance value, insurable value. Here two conditions will come. Suppose first, if your policy amount is more than or equal to insurable value, which is given in the above example. You have taken a policy amount of 110, but your insurable value is only 100. So my condition satisfied. The policy amount is more than equal to insurable value. Then what we will tell this one? It is sufficiently insured, you can say. It is sufficiently insured, or in general term also we call it as over-insured. Over-insured. In this case, what will happen? You will get the total claim payable will be equal to loss. In this case, claim will be equal to loss, but not more than your policy amount. But not more than your policy amount. This is one case. The second case you may get, here what the other case is, your policy amount is, let us say, less than the insurable value. Suppose here you are getting the policy amount so when the policy amount is less than this, then it becomes underinsured. And your law of average will work now. Here you see that. Suppose policy amount is less than IV, then underinsured, and law of average will apply. In this case, what you will do? You find out first what is the underinsurance coefficient. This is a very important step. You find out the underinsurance coefficient. What is that equal to? It is nothing but your policy amount divided by your insurable value. In the theory also, we have already seen some examples. Now the claim payable will be underinsurance coefficient into that claim amount, but not more than the insurable value. This is very, very important. In a case study, we'll see that. Suppose you have reinstatement clause, then no depreciation will be applied. Then if policy excess is there, it should be deducted from the claim payable. Now let us go to one example. First example, very simple one I have taken. Here the details of a property are as under. The year of construction is 2001. Land area is 2000 square feet. Built up area is 1000 square feet. Life of building is 50 years. Salvage is nil. In 2026, construction cost is giving 2500 per square feet. Land cost is 2000 per square feet. Foundation cost is telling 10% of building cost. So first you note down, he may not have given like this. He will write in a story. In the next example, I'll show you. He will write in a paragraph. from the paragraph, first bring out these things in a rough note so that it will be easier for you to work out. As a valuer, suggest the insurable value. How, for what amount you will go for insurance. Under two items he is asking, first is a standard insurance policy. Another is policy with reinstatement clause. You see, he is confusing you. We know that in insurance, land has nothing to do. Land is not destructible. So this data I don't want. This land value I don't want. This land cost also I don't want. Now, first as a standard insurance policy, what you have to do? Just now we have seen steps. First you find out what is the replacement cost. So replacement cost is very simple. Built up area is given 1000 square feet. Rate is given 2500 per square feet. So if you multiply, you will get 25 lakhs is your cost of construction. Then we have to find out the depreciation. How to find out depreciation? We know the formula. Depreciation is age divided by life into 100. Why 100? Because salvage value is nil. Now, what is the age of the building? He is telling in 26. That means loss has occurred in 26. He wants you to tell what should be my insurable value. 2001 it was constructed. So the age is 25 years. Life is 50 years he has given. So your depreciation became age divided by life, that is 25 by 50. So 50%. Is that clear? So you can see in this slide now. First answer I have given. Replacement cost in 2026 is 1000 into 2500 is 25 lakhs. Now what I have done here, first I have deducted the foundation cost. You can first deduct or second also you can deduct, but I will tell how to deduct if you are deducting later. Here foundation cost he has given 10%. So I have deducted, let us say first foundation 2.5. Now the building cost became 22.5 lakhs. Now we have found out the depreciation, age divided by life into 100, it came as 50%. That means the depreciated replacement cost is also 50%, 100 minus 50. So what is the depreciated replacement cost without foundation cost? Is 50% of 22.5. Because without foundation cost, the value is 22.5. So it became 11.25 lakhs. So what is the insurable value? The definition of insurance value is, this is the net present value without foundation. Net means without depreciation. So the answer is now 11.25 lakhs. But in the example, you might go directly also like this. You know the depreciation is 50%. Foundation cost is given 10%, means the value of the building without foundation is 90%. So directly you multiply 0.5 into 0.9 into 25. Also you will get the same answer. Is that clear? This red line you concentrate. Your cost is 25 lakhs. You have depreciation of 50%. So the depreciated value is also 50%. So 0.5 into 25. Now I should not take foundation. Foundation cost is 10%. That means the superstructure cost is 90%. So your answer is 11.25 lakhs. Now in the second case is very simple. He wanted the replace this insurable value as reinstatement clause. There is a reinstatement clause. Once reinstatement clause is there, what you have to do? You don't take depreciation. You need not take depreciation. So here you can see now the cost is 25 lakhs. Simply deduct foundation cost 2.5 lakhs. So the replacement cost without foundation is 22.5. So the insurable value is 22.5 lakhs. That clear? Now, next example. A building was constructed in 2006 with 2000 square feet with cost of construction as 2000 per square feet. The building was insured for 36 lakhs. That means what do you mean by that? The policy amount is given as 36 lakhs. Life of the building is given 60 years. Similar cost in 2026 may be taken as 3000 per square feet. Again, he started confusing you. Which value we have to take? While finding insurable value, always at the time of loss. Value at the time of loss. So you have to take this 3000 rupees per square feet to find out the replacement cost. Salvage is given 10%, foundation is given 10%. So now you see the solution. Built up area is 2000. I have written down the data from the paragraph. Year of construction 2006. Built up area is 2000 square feet. Policy amount is 36 lakhs. Life 60 years. In 2026, replacement cost is 3000. Salvage value 10%. Foundation cost is 10%. First question is asking you, in 2026, a major fire broke and the damage is claimed 35 lakhs. That means the owner of the building is claiming 35 lakhs. Find the claim payable. So as a valuer, now suggest how much claim will be paid. Now you see, first calculate the replacement cost, 2000 into 3000, so 60 lakhs. Age is given 20, life is 60, salvage is 10. So depreciation percentage you can find out, age divided by life into 100 minus salvage value, it is coming 30%. So depreciated replacement cost will be how much then? 70%. 70% of 60 lakhs, that is 42 lakhs. Now insurable value is nothing but depreciated replacement cost less foundation cost. So you multiply 0.9 because 10% is your foundation cost. So your insurable value came as 37.8 lakhs. Is that clear? The first step I had given, find insurable value. For that, find replacement cost, find depreciation, allow depreciation, and deduct foundation cost. So your insurable value is 37.8 lakhs. But policy amount, how much he has taken? He has taken policy for 36 lakhs. So underinsured, he should have taken the policy for 37.8 lakhs. But he took the policy only for 36 lakhs. So this is underinsured. Then condition of average will be applied. Then find out the underinsurance coefficient, that is policy amount by insurable value. It comes to 0.952. So what will be the claim payable then? Underinsurance factor into the loss. Loss he claiming is 35 lakhs. So he will be paid only 33.32 lakhs. Is that clear? Though he has taken a policy for 35 lakhs, he will not be paid 35. That is indemnity clause. Because his policy is underinsured by a factor 0.952. So 0.952 into 35, he will get only 33.32 lakhs. Okay. Now let us go to second question of this. Here is everything is same. He is telling now he is claiming a loss of 40 lakhs. In the previous example, he was claiming a loss of 35 lakhs. Now he is claiming a loss of 40 lakhs. Same as previous, we have to find out insurable value. That has no
फ्रेंड्स,
change.
अगर केस स्टडी में आपको इंश्योरेंस से रिलेटेड क्वेश्चन आएगा तो कुछ कुछ इससे मिलता जुलता आएगा, तो कुछ केस स्टडीज हमने यहाँ पर अभी कोशिश किया है आपको दिखाने का. ये केस स्टडी है, इसके बाद भी एक दो तीन केस स्टडीज हैं. अगर आपको एग्जाम में इंश्योरेंस के रिलेटेड क्वेश्चन आया तो बहुत स्कोरिंग है, और ये 100% मार्क्स आपको लेने चाहिए। तो इससे मिलता जुलता ही क्वेश्चन आपको वहां पर आएगा और इससे ज्यादा कुछ नहीं आएगा। थोड़ा बहुत आप थोड़ा ट्रिकी क्वेश्चन अभी आ सकता है, आगे आने वाले कुछ स्लाइड्स में हम देखेंगे कुछ ट्रिकी क्वेश्चंस कैसे वो पूछ सकता है, लेकिन इस पे कंसंट्रेशन करिए। बहुत सिंपल है, बहुत स्कोरिंग है और ये नंबर आपको लेने ही लेने हैं। यस सर, ओवर टू यू, सॉरी टू इंटरप्ट।
If you just go through those 2 to 3 case studies I have given, every type it will cover. So in the previous case, you had only 35 lakhs. Now he is claiming 40 lakhs. The insured can claim any amount. Now, in the previous case, we have calculated the insurable value that has come as 37.8 lakhs. What do you mean by insurable value physically, you tell? Insurable value is nothing but the value of your property on the date of loss or today. If the value of the property is 37.8 lakhs, can the owner make a loss of 40 lakhs? Because the value itself is 37.8 lakhs. So here the loss will be limited to 37.8 lakhs. To confuse, he will be giving you questions like this. So never the claim will be more than the insurable value. That is what we had written. You see, if I go back to the slide, the procedure, here I have written. In the 7th one, you see this, but not more than the insurable value. So every point you have to be very careful here. So since the insurable value is 37.8 lakhs, the loss is only 37.8 lakhs. Now again, your problem becomes simple. Further policy amount he has taken is only 36 lakhs. So again, underinsured. So underinsured coefficient in the previous case, we have already calculated 36 by 37.8, now 0.952. Here also same values, 36 lakhs is your policy amount. Oh, here, sorry, here I have taken the same example. Correct. Policy amount is same. He has claimed a damage of 40 lakhs, but he has taken a policy of only 36 lakhs. So under insurance coefficient will be same, 36 by 37.8. So it is 0.952. Then what will be the claim payable then? So it will be 0.952 into 37.8, not 40. Don't take here 40. Because the loss cannot be more than insurable value. So he will be paid only 36 lakhs. That is why in theory also it is told, in case of total loss, if the policy is underinsured, it will be equal to policy amount. You need not calculate also this. This is directly you can say it is 36. If you calculate also, the same value will come in case of total loss. What do you mean by total loss? When the claim is equal to the insurable value. Here the claim was more than insurable value, which is not possible. So we restricted the insurable value to claim loss. Okay. Third question. If the policy amount is 40 lakhs and a major fire broke and the damage is claimed is 40 lakhs, then what is the claim payable? What is the difference between this question now? Here, now the policy amount is 40 lakhs. Previously, it was 36 lakhs. Suppose he has taken a policy amount of 40 lakhs and he is claiming a loss of 40 lakhs. Now what will happen? The third type. Here you see, first we calculate the insurable value. Insurable value is how much? 0.9 into 42, 37.8, like last one. No change in that one because cost of construction is same, age is same, life is same. So depreciation is same, foundation cost is same. So that 37.8 lakhs will not change now. But policy amount is 40 lakhs. So what happened now? Sufficiently insured. Why? He has taken the policy more than the insurable value. He should have taken a policy for 37.8 lakhs, but he has taken for 40 lakhs. So he is sufficiently insured, over-insured. Then what will happen? Then whatever claim he is making, you can pay. That does not mean that 40 lakhs you can pay, because the loss cannot be more than 37.8 lakhs. Because the value of the property itself is 37.8 lakhs. So total 37.8 lakhs you can pay here. In the previous case, you were paying only 36 lakhs. But now you are paying 37.8 lakhs. Is that clear, or any doubt is there? You see, here insurable value is 37.8 lakhs. First, make a note, your loss cannot be more than that. I am having a property which is valuing 37.8 lakhs. How I can make a loss of 40 lakhs? So forget about that claim of 40 lakhs. It is now 37.8 lakhs is the claim. It is sufficiently insured. So pay 37.8 lakhs. Very simple argument. If the policy amount is 40 lakhs in 2026, a major fire broke and the damage claimed is 40 lakhs, find the claim payable if the policy has a reinstatement clause. What is the difference now? Previous question and the same, but he is telling this has a reinstatement clause. That means no depreciation is allowed. No depreciation is allowed. So we had seen the replacement cost had come to 60 lakhs. Now what will be the insurable value then? From 60 lakhs, you have to deduct only foundation. No depreciation. So 0.9 into 60, so it is 54 lakhs. That means the person should have gone for an insurance of 54 lakhs. Here the valuer's work started. The valuer should have suggested him, sir, you are taking reinstatement policy, you should go for an insurance of 54 lakhs. But he has taken an insurance of only 40 lakhs. So underinsured. So find out underinsurance coefficient, multiply by the loss. You see this. Replacement cost is 60 lakhs. It's due to reinstatement clause. No depreciation to be allowed. So insurable value came as 54 lakhs. Since policy amount is less than insurable value, policy is underinsured. Policy amount is only 40 lakhs. Underinsurance factor formula is policy amount by insurable value. So 40 by 54, it is 0.707407. So how much claim will be paid? Only 29.63 lakhs. 0.7407 into 40. You see, he has taken a betterment clause. It is a betterment clause, reinstatement clause. That is, he should have got more money. Actually, he should have got up to 54 lakhs he can get. But he has not taken the policy up to 54 lakhs. He took only for 40 lakhs. So he is penalized. He got only 29.63 lakhs. If in the same one reinstatement is not there, he is getting more, you can see. In the previous case, we have seen 37 lakhs he is getting. But he introduced a betterment clause for better purpose. But he got less amount. Are you able to follow my point? He did
देखिए
a
यहाँ पर हरिहर राव जी का कहने का मतलब है उसने फायदे के लिए रीइंस्टेटमेंट पॉलिसी लिया, रीइंस्टेटमेंट क्लॉज लगाया, लेकिन क्लेम लेते वक्त उसको लॉस हो गया। क्यों? क्योंकि वो ही वॉज नॉट अ ऑनेस्ट पर्सन, क्योंकि उसने उसको अंडर इंश्योर किया हुआ था। अगर फुली इंश्योर्ड रहता तो उसको बेनिफिट होता, लेकिन क्योंकि उसने अंडर इंश्योरेंस लिया हुआ था तो इसलिए उसको लॉस हो गया। रीइंस्टेटमेंट पॉलिसी लेने के बाद भी उसको कम अमाउंट मिलेगा। Over to you, sir.
So the next example is very simple. I'll just skip out. The same. He took for 5 crores, but he did a policy of 3 crores. So under insurance coefficient is 0.6. So he will be getting only 0.6%. But here we have given one more point in this that only we'll discuss here, that debris removal. What about the debris removal? He will get 1% of the claim amount here. The claim amount is now 90 lakhs. So he will be getting a 0.9 lakhs extra. He has taken replacement cost is 5 crore. Policy has taken only 3 crore. Loss happened 1.5 crore. But he will not get 1.5, though he has gone for a 3 crore because underinsured. Underinsured coefficient came as 0.6. So he is getting an amount of only 90 lakhs. That debris removal, if you add, he will get another 90,000. He has asked if the debris removal is there, how much he will get. Okay, this is another building was constructed 2006, 2055 lakhs, life of the building 3,000, salvage value. It is also more or less same type. I think I will skip out this. You can practice it. These things will be supplied to you. So you can practice this example. It is same as the example we solved now. No change is there. This is another example. It is a repetition of your cost index method. Here he is telling the problem is same. A building was constructed in the year 2010 at a cost of 20 lakhs. The owner has taken a standard fire insurance policy for an amount of 30 lakhs. You see, at that time, the cost was 20 lakhs. And apprehending that this is going on increasing, so he has increased the value to 30 lakhs. In the year 25, a major fire broke and the building was damaged to the extent of 20 lakhs. The cost index for 2010 and 2025 may be taken as 167 and 363 respectively. Assuming foundation cost as 10% and salvage value nil, life of the building may be assumed as 60 years. Find the claim payable. First question. Second question is, owner had taken two policies with 20 lakhs and 10 lakhs from two insurers, X and Y. Claim to be paid by each insurer is how much? What is the principle in the above case? Just 2 to 3 minutes you take and note down the data first. Let me see how much you are carrying. Just note down the data.
फ्रेंड्स, एग्जाम में कुछ कुछ इस तरह का क्वेश्चन आता है, आप इसको प्लीज ट्राई टू सॉल्व इट बाय योरसेल्फ. आप पेन पेपर या एक्सेल शीट में आप इसको डाटा नोट करिए. ट्राई टू सॉल्व बाय योरसेल्फ. अगर
आज थोड़ा टाइम कम हो रहा है, नहीं तो मैं उनसे करवा देता पूरा.
जी सर.
बट एक्चुअली the time is a little bit
सिलेबस काफी बड़ा है. टाइम हमारे पास लिमिटेड है क्योंकि 3 का वेटेज है, तो इसलिए वी आर ट्राइंग टू.
सर 3 का नहीं सर, इसको मिनिमम 9 वेटेज मानिए सर.
जी बिल्कुल बिल्कुल. ट्राई टू सॉल्व दिस क्वेश्चन. अगर ये क्वेश्चन में आपको कोई भी डिफिकल्टी है तो यहाँ पर अगर आपका गलत भी होता है तो डोंट हेजिटेट टू आस्क. रेज योर हैंड एंड आस्क योर डाउट अगर कोई भी डाउट है. अदरवाइज वी विल ट्राई टू सॉल्व.
Okay, you see here, first step, what is the first step for us? We have to find out the replacement cost. In the earlier example, it was plinth area rate. You were given the plinth area and the rate, today's rate. So you are multiplying and getting the replacement cost. Here what he has told, that he has constructed the building at a cost of 20 lakhs in the year 2010. And in 2010, the cost index was 167. Now in 2025, the cost index is 363. So what will be the present cost of construction then? It is very simple. 20 divided by 167 into 363. Which is
अगर इस तरह का क्वेश्चन आपको एग्जाम में आता है तो 6 मार्क्स का होगा. 3 क्वेश्चन अगर आएंगे, अगर 4 आएंगे तो 8 मार्क्स का होगा. अगर उससे ज्यादा आएंगे तो नंबर ऑफ मार्क्स बढ़ सकते हैं. अगर 6 आएंगे तो आपको 12 मार्क्स का हो सकता है. अगर 6 मार्क्स का आया तो ये 6 मार्क्स देखिए कितने आसान है आपको एग्जामिनेशन में. ये 6 मार्क्स आपको लेने कितना आसान है. यस सर, ओवर टू यू.
सर ऐसा भी होता है कि कॉस्ट मेथड में एक प्रॉब्लम वो दे देता है, उसमें से 6 प्रॉब्लम है, 6 का 6 5 कॉस्ट अप्रोच से रहेगा, जैसे कि ही विल आस्क हियर व्हाट इज द डिप्रिसिएशन परसेंटेज, व्हाट इज द कॉस्ट ऑफ कंस्ट्रक्शन इन द ईयर सो एंड सो, फाइनली ही विल ऐड व्हाट इज द इंश्योरेबल वैल्यू।
बिल्कुल बिल्कुल, मिक्स करके भी क्वेश्चन आ सकता
मिक्स
है
करके भी। So here now you can see this answer. First is replacement cost in 2025. You find out by using this formula 20 in 2010. So 20 divided by 167 into 363, or the formula we wrote, base year construction cost is 20 into cost index of today by cost index of base year. So you get this value as 43.47 lakhs. Find out the depreciation, very simple, age divided by life into 100, because salvage value is 0. Age is 15 years, 2001 and 2026, 2011. So 15 by 60 into 100 is 25%. Yes, 2010. So 15 years. So the depreciation percentage is 25. So what will be the depreciated replacement cost? It will be 0.75. Don't make a confusion here. So 0.75 into 43.75 is 32.6. I am just calculating step by step, because in the exam he may ask you separately. One of the option will be what is the depreciated replacement cost at the time of loss? That is 32.6 lakhs. What is insurable value? That is depreciation replacement cost minus foundation cost. Be careful here. Sometimes people make mistake like this. Foundation is given 10%. So 43.47 is 10% they deduct. You will get a wrong answer. Because we have already calculated the depreciated replacement cost. So foundation has also depreciated. This 4.34 is original. Now it will be only 3.26. Now what is the foundation cost? 3.26. If you take 3.26 deduct, it is okay. So to avoid this confusion, I told always use coefficient. That will not give you wrong answer. Your foundation is 10%. So without foundation, it is 90%. Your depreciation is 25%. So without depreciation, it is 75% with depreciation. So you get this 32.6. Now insurable value came as 0.9 into 32.6. It is coming as 29.34 lakhs. What is the policy amount given? 30 lakhs. That fellow is cunning fellow. Though 20 lakhs he had constructed, he has increased his insurable value. Because during time, though you apply depreciation, your value may be more. Because real estate, appreciation is there. So he has taken a policy of 30 lakhs. So since policy amount is more than insurable value, it is sufficiently insured. So claim payable will be loss amount that is equal to 20 lakhs. He will get direct 20 lakhs. Is that clear? So it helped you to know how, in case of sufficiently insured property, how we will calculate the loss, and in cost index method, how to calculate the value, which we would have already done in cost method. Now, second question is, what is that second question? He has taken 2 policies from X and Y. That 30 lakhs, what is this 30 lakhs he has taken here? He has taken from 2 companies. From one company, he has taken 20 lakhs. From other company, he has taken 10 lakhs. So how much they will pay? So in the proportion of 2:1, they will pay. It is very simple. So that I have shown here. Claim paid by X will be 20 by 3 into 2. This is 20 by 3 into 1. That is 2:1 ratio. Or else you can do like this. This loss amount, what is the loss amount? 20 by total insurable amount, policy amount is 30. First policy, how much he has done? For 20 lakhs. So he will give for 20. Second one, similarly, 20 by 30. Second one, he will give for 10. Like that also you can calculate. Okay. So first one he will pay 30.33 lakhs. The second fellow will pay 6.67. Totally he will get that 20. What is this principle called? In theory we have studied. He is asking what is the principle of the above case. We had seen 6 points. In that one was this one. This is the principle of contribution. This principle of contribution. I think if you go through this much of example very thoroughly, no other than this we will get. Basic point to remember, never the loss or claim will be more than the insurable value. The owner may claim whatever amount he wants, but it cannot be more than the insurable value because that is the net value of the property. Compare policy amount and insurable value. If policy amount is more sufficiently insured, total claim he will get it. If policy amount is less, then underinsured. You find out the factor by which it is underinsured. According to that factor, the claim you multiply, you will get that amount. If reinstatement clause is there, don't apply depreciation. If policy excess is there, deduct that amount. Suppose in the above case, he would have told, if there is a policy excess of 10,000, what is the claim payable? It will be 20 minus 10,000. 20 minus 10,000. So 19.9 lakhs you will pay. Okay. Sometimes you will tell policy excess 10,000 and franchisee is 20,000. Then 30,000 you deduct. Whatever, whenever that excess what is there, those amount you deduct it. Okay.
कहीं भी आपको पॉलिसी एक्सेस दिया हुआ है, अगर 10,000 दिया हुआ है, वो तो 10,000 फाइनल क्लेम से डिडक्ट करना है. जितना अभी मिस्टर राव ने बताया, जितने एग्जांपल्स आपको दिए हैं, इसमें से ही आपको इससे रिलेटेड ही घुमा फिरा के वो क्वेश्चन पूछेगा. जितना भी घुमा फिरा के क्वेश्चन पूछे, इसमें से ही आने वाला है. तो अगर आप इतना सा भी अगर प्रॉपरली आप कंसंट्रेट करेंगे, तो 90% चांसेस है कि आपके क्वेश्चन सभी, आंसर सभी करेक्ट होंगे. यस सर, ओवर टू यू.
Sir, we will go through some MCQs very fastly. After that, I will take up the doubt. I am available till midnight. Only it depends on the participants.
Yes, sir. Yes.
Okay, let us see the MCQs. They are very, very interesting. First one, which fundamental principle ensures that an insurance policy has a mechanism for financial recovery and strictly prohibits the policyholder from making a profit from a loss? All we have discussed in the theory. See, while doing this MCQ, always check all the four. What is subrogation we have told? That is third party. If somebody made some mistake, you can collect money from them. Like I told, building, adjacent fellow constructed a building. That is subrogation. What is contribution? Just now we did 2 to 3 policy you have taken. They will be paid separately, proportionately. Utmost good faith is be honest. So here, the main is your indemnity clause. Indemnity clause tells that the insurer will pay the exact amount of loss, not more than that, though your policy amount is more. So the answer will be indemnity. You see the example, this answer, explanation also I have given. The principle of indemnity aims to restore the insured building in the same financial position they occupied immediately prior to the loss event. Profit making violates this core legal objective. No profit making. You have to remember indemnity. For a building insurance contract to be legally acceptable, the insured must possess a lawful financial relation to the property, meaning they benefit from its safety or suffer from its damage. This is defined as, just now we saw indemnity, it will not come. He will pay only the loss. Proximate is nearest clause. Material fact is different. So main is your insurable interest.
Try to
C is correct
eliminate
answer.
the incorrect match.
Yes, C is the correct answer. Without insurable interest, such as ownership, mortgage interest, or legal trusteeship, and insurance contract is treated as a wager and is legally void. In property insurance, at what specific timeline must be insurable interest legally exist in order for a claim to be valid? Only at the inception of the insurance policy. Only at
C is the correct answer.
both at the inception of the policy and at the time of loss.
Loss.
So you are telling C is the correct answer. Anybody else? Suppose, of course, now we are dealing with land and building.
Yeah,
Same, this property word would have been replaced with a marine ship. The answer will be different. C will not be correct. What is this? Let us understand. Unlike life insurance, in case of life insurance, what happens? At inception or marine insurance, last time only. Standard property and building insurance requires insurable interest to be present both when buying the policies and when the damage occurs. In very simple language, I will explain. Suppose you have taken a policy for your property. For 1 year premium you have given. After 6 months you sold it to Y. Then that insurable interest gone. That policy lapsed. That will not be transferred to that fellow. He has to again take a policy. Are you able to understand? So here he is telling both at the inception while taking the policy and at the time of loss also he should be there. He should have that insurable interest. Suppose I have sold it, then I don't have any more insurable interest in that property. So in case of building, the answer is C. Under the principle of utmost good faith, that Latin word is unberima fide. Sometimes they use those words. Sir, even in the exam, sometimes spelling this, that they are doing. I had got, of course, I should not reveal. A building failing to disclose that portion of a residential building is used to store highly inflammable commercial chemicals. He is guilty of
Guilty of C. Sir, C. इतना बार नहीं बोलिए, इतना बार क्यों बोलते हैं? एक बार.
Those who are telling A, subrogation, what is that one? From third party you have to collect. In case of any defect, you have to collect from the third party. You say C is looking little bit more correct to you.
It's a misrepresentation.
But what is this word called? Innocent.
They are not innocent. They did purposely.
Then this answer will not be correct.
It's a breach of subrogation.
B. Material fact.
This is not an under
Material fact.
So this is not correct. This is not correct. This is not correct. So answer
Material
will be automatically.
Concealment of material fact.
Concealment
Yeah.
material
And
fact.
if you see also it is same thing. He has kept some inflammable, highly inflammable commercial chemicals, but he has not intimated. So he has concealed that material fact.
नहीं
Okay.
पागल है.
Answer is
Sir,
B, concealment of.
sir, can you
Yes.
once explain subrogation?
You see, subrogation, I had given you an example also. Suppose I have constructed a building. Nearby plot owner, he started constructing a building and he made a large ditch.
That
दाई कर दिया.
our damage from that to us.
The damage is by a third party.
Okay.
To
You
us,
are-
our
you see,
building.
In this language like this, you are driving a car and you are parking at one place, safe place at parking. Another
Some
vehicle
other
came and hit you.
Hit.
And your vehicle got damaged. So there that subrogation will come. The damage was due to a third party, not due to you. So the insurer will claim from that fellow. Okay. If an insurance company pays a total loss claim to a building owner for a collapsed structure Any remaining scrap value or salvage rights of the debris legally transferred to the insurer under the principle of. It is very simple because subrogation is not correct, contribution is not correct, indemnity is not correct. These three already we have seen now. Subrogation is third party, contribution is 2 to 3 insurance companies should be there. Indemnity is he will pay for the loss. So automatically abandonment and salvage. Also this word is there here, salvage. In the question itself, answer is there. So once the insurer pays a full indemnity for a total loss, they succeed to right to over whatever remains. The principle of subrogation gives the insurance company the legal right to. Now you can answer. Subrogation just now we discussed. Anybody?
Sir,
B.
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 B, sir. B.
Okay. So B you are telling. Yes,
B.
you say like this. Force the policyholder to buy additional. This has no link. Okay, subrogation is not buying additional. So this answer is not correct. Collect premiums for multiple banks, not correct, not related.
Responsible for
Reduce
a
the
loss
claim
in the
payout
claim.
proportionately. It is only under insurance. This is also not correct. So the answer is also correct that sue a negligent third party. Whenever subrogation comes, you think of third party. Okay. So answer is B. If a commercial complex is insured against fire with 2 different insurance companies for its full value and a fire causes partial loss, how is the claim settled? Under principle of contribution he has given, or this would have been also a MCQ. What is the principle? He has given one of the answer.
B.
Option C.
Who told B?
C, sir, C.
C.
Yes, C is the right because proportional what is there you see.
D.
Proportional share.
We
Yes.
have just seen some example also. You take 2 policies, 30 lakhs from one, 60 lakhs from other. So 1:2 ratio you are paying.
Contribution.
Contribution. So this answer will be
Yes.
C. Okay.
Okay, sir.
If an insured building is damaged by earthquake, which triggers a gas line burst, which then causes a major fire, the legal tool used to determine whether the policy covers the damage is called
Option A.
Approximate cause analysis.
Yes.
Approximate
Proximate clause, we have already seen this example.
Yes.
Is it not? It is the nearest cause you have to find out. When calculating the sum insured for a building insurance policy, component must be completely excluded to avoid skewed valuation and overpayment of premiums.
A. Deep foundation below ground level.
See, sometimes I had told in the interview also, sometimes they will confuse. Don't answer immediately by reading only one option. Please,
C.
Market value
more
of the land
appropriate
plot.
you check up.
Market value of the land. Market value of the land plot.
Yes. First thing you know that the most appropriate is we don't consider the land in insurance.
Land plot. Yes.
Deep foundation, sometimes you can go for add-on policy. No, add-on policies are there where the foundation can also be added up. In general, foundation is not given. But in case
But
of deep
land plot is
foundation, because the
completely
foundation
excluded.
cost is very large,
Completely excluded.
sometimes they give extra premium and insure for that also. But land can never be insured. Okay? So the answer
Okay,
is
sir.
B.
D होगा sir.
The answer is B.
RCC frame structural superstructure.
What happened?
D. Sir,
Why D? See, here you read this completely excluded,
B. Land.
not
B,
included.
sir.
Sometimes not what is coming, similarly here excluded. Okay, so the land is excluded.
A.
Hey, bhaiya, already I have shown here the answer and told that the land is not insurable. The previous one only I had explained you. Okay. Under a reinstatement value policy, the settlement of destroyed building is based on the cost of replacing or repairing to a state.
Equal to proceed.
B.
A.
Option A.
Option A.
Option A.
Option A.
Second one, what I have written, equal to its current depreciated book value. Depreciation is not there in case of reinstatement value. So this is
Yes.
not correct. Matching the current prevailing real estate market transaction. Market transaction has nothing to do. In insurance, particularly. No comparative method will be work here.
Yes.
Okay. Because the
Okay.
cost of construction is important here. Same building in a POS area and little bit away from POS area will be different market value.
ये इतना
But for
पढ़ने ना
insurance it
बोलिए
is
कुछ तो
same.
बोलते हैं एक बार बोलिए ना एक बार बोलिए
Utilizing cheaper, this is not correct. The same material you have to use. So the answer is
A.
A. Debris removal expenses are included in an institutional building insurance policy to cover the cost of, there already answer I have given, clearing, carting away and safely disposing structural rubbish. This is a very simple one. Because other things are not correct. Excavating foundation, not correct. Purchasing construction materials, no. Transporting salvage, no. It is only the clearing of debris. Which valuation approach is best suited for insuring historical monuments? Heritage buildings. I have already told this one in theory.
Book value.
Agreed value.
B.
Yes,
Agreed value.
Agreed
Agreed value.
Yes. At that
Agreed
time, I
value,
told,
yes.
no, you both agree that, okay, 50 lakhs or 50,000, like that. Okay. So, agreed value.
B. Agreed value.
If a building is valued using plinth area rate method for insurance purpose, the valuation is derived from, this is actually cost method MCQ.
B.
B.
B. Okay. Because other things are
B.
clearly so. Carpet area you cannot take. Okay. Volume is volume method. Cubic content method. Perimeter is not
B is
taken.
total
So
built
answer is
boundary.
B. Okay.
Okay, sir.
Over insurance occurs when a building is insured for a sum greater than its true replacement or actual value. In the event of total loss under an indemnity policy, how much will the insurer pay? The full exaggerated sum insured, no. In the example also we saw.
Option B.
The true actual loss or replacement value matching the principle of
10%.
indemnity.
B.
So B is the right answer. Okay. What major risk does an owner face if they index their building insurance policy strictly to the historical accounting book? This also I told you. Book value method only for accountant purpose, not for valuers, for this insurance. What will happen if you take the book value? What will happen?
Extreme underinsurance.
Very simple. Simple idea you apply. 100 lakhs building is there. After 50 years, let us say 50% depreciation. If you insure for 50 lakhs, will it do? Already market value would have increased. We have told, no, real estate has appreciation. So it will become underinsured. We saw in that example, 20 lakhs was book value. Even without depreciation, 20 lakhs if you take, you will be in loss. He has taken a policy of 30 lakhs, that's why. So it will become extreme underinsurance due to escalating market construction. Condition of average or average clause in a property insurance policy is designed to punish which of the following practices?
Option B.
Yes. Very good. Deliberate underinsurance. Average policy is coming.
Hey, Harsh. Harsh. Hey, Harsh.
Oh, kindly mute yourself. Okay, like this, also MCQs are coming small case study type. A building with a true reinstatement cost of 2 crore is insured for 1.2 crore. Actually, the value is 2 crore, but that fellow insured only for 1.2 crore. A localized electrical fire causes a structural partial loss of 40 lakhs. So how much he will pay?
24 lakhs.
24.
40 lakhs only.
How much?
24 lakhs.
Very good. How you got? Actually, he has done 60% insurance.
24 lakhs. Yeah.
Is it not? Actually, property value is 2 crore. He has taken a policy of only 1.2. That means 60%. So he will get 60% of 40 lakhs. 24 lakhs he will get. Suppose a factory building valued 50 lakhs is insured for 40 lakhs. And there is a resulting in engineering loss of, there is a loss of 50 lakhs. What is the maximum liability of the insurer?
40 lakhs.
So 40 lakhs. Because you cannot pay more than your insurable value. Okay.
Yes, yes.
What does a compulsory deductible or excess clause in building policy signify?
B.
This deductible also we have discussed.
The
Excess policy. What is that excess policy I told while teaching theory? It is that a processing fee. Is it not?
Statutory tax deduction.
10%.
The fixed initial sum. What does a compulsory deductible in the policy excess clause he is asking? It is a fixed initial sum of any admissible claim that the insurer must bear out of pocket.
Pocket.
From his pocket he has to spend. So answer will be B. It is not for surveyor. Surveyor is different. That is 3%. So answer is B. A deductible is the initial threshold of a loss that the policyholder handles themselves. How does a voluntary deductible differ from a compulsory deductible? That is in the policy, voluntarily you tell. Actually in the policy there is 10,000, but the insured is agreeing to go for more deduction. However, he is telling if there is a damage, you deduct instead of 10,000, you deduct 1 lakh. Like that. Voluntary deductible. By opting for a higher voluntary deductible, the building owner signals to the underwriter that they will absorb minor losses. That is, small amount of loss means he will not ask, because suppose 50,000 you disclose as your voluntary deductible. What will happen? Up to 50,000 you will not get anything. So for small damages he will not claim. In cars also we see, suppose we get a no claim bonus. So small damage, suppose 2,000 rupees, we don't claim that one. Because next time we will get some benefit. Similarly, voluntarily you apply that you deduct this much. So what will happen? Your premium will decrease. There will be a direct reduction in the premium. This is the word very important. Under a reinstatement value policy, if the insured decides not to rebuild, or repair the damaged structure after a fire, but instead closes operation, how is the claim settled? This also I told you. Within 1 year, he has to construct. Suppose he is not constructing a new building, what will happen? That reinstatement clause will not work.
Liquidation workout.
Hmm?
B.
We have told already automatically the reinstatement clause will close. It will become a normal clause. So answer will be B. Reinstatement term requires actual reconstruction as a prerequisite for a new for old payout. If the owner opts for not to rebuild, the policy reverts to an indemnity minus depreciation framework. Then standard fire and special perils policies typically convert the structural damage resulting from inherent explosion. Which of the following scenarios qualifies under this clause? A very simple one.
A.
You always read 4. You think which is actually proper.
B. Dynamic mistake.
Explosion of an industrial scene. Yeah.
A is the.
Gas cylinder.
He is asking qualifying. Which of the following scenario qualifies under this clause? If you keep a blasting material, it will not qualify. Explosion in the industrial steam boiler will not qualify. Dynamic missile. So a gas cylinder explosion inside a residential kitchen.
कुछ बोल देगा नहीं तो लटिए पढ़िए ना.
Which of the following atmospheric hazards is universally classified under the STFI group?
Option B.
Yes, the storm, cyclone, typhoon, tempest, and flood damage. These are the STFI group. The last one, if a building is completely abandoned or left entirely unoccupied for a continuous period exceeding 30 days without notifying the insurer, what is the impact of the policy? In the theory, we have seen this word.
B.
Theft, vandalism, damage. So B is the right answer. Okay.
B.
So actually, I had given a time period of 2 hours, maximum 2.5. So 2.5 also crossed. So actually, the course is little bit heavy, but weightage is more. Don't think it is only 3 marks because it covers other topics also. You would have learned little bit again reinforced your cost index method also. Cost method. You know, if you have any specific doubt, even after this, you can ask.
Sir, I have a doubt actually, sir. So I have taken a flat for 60 lakhs and I have taken a bank loan, but it is some damage has occurred. But how the insurance policy will works? I mean, the total amount will I get to the bank or for me or for a third party? How it scenarios works?
No, you see, you have taken a loan of 60 lakhs from the bank or whatever you have taken. That is a separate story. You have insured of the building or not?
Yes, sir. I have insured about 40 lakhs.
You have insured about 40 lakhs. So up to the range of 40 lakhs, insurance company will give it to you.
Okay.
Because you are having your insurable interest, you have insured. Now bank, you have taken a loan of, let us say, 30 lakhs from the bank.
Okay.
What bank will do? He will insure again.
Okay.
He will insure for your life.
Okay.
You see, generally what happens if X has taken a loan and something happens to X, he cannot give back the loan. So bank will take an insurance against that property up to 30 lakhs.
Okay.
He will not give you. Bank for his safety.
Okay.
For that X fellow, that 30 lakhs may be waived out because he is no more.
Okay.
But from where bank will get?
From the insurance company.
So bank will make an insurance. And he will charge that insurance fee from you also. You would have
Okay.
seen in the loan account, insurance charges from 352 rupees, very small amounts will be deducted.
So the loan amount will be deducted, right, sir?
No, loan, that is what I am telling. In
Okay.
case any problem happens and you are not able to pay,
Okay.
then the bank has a insurance, separate insurance. He will collect that insurance. But suppose your building collapsed, you should have your insurance to get back that money.
Life insurance.
Yes.
Okay.
You will be doing property insurance. Bank will be doing life insurance for you.
Okay.
You don't mix up both. Bank will
Got
not
it.
pay you.
Okay, got it, sir.
So please,
At that time, what bank will do? He will check that whether your insurable value is perfect or not.
Okay.
He is giving a loan of 40, but you have taken a policy of 30. He may reject it.
Okay.
So please, can we discuss once indemnity?
Indemnity is nothing but very simple language. If you tell, it is the duty of the insurer, that company, to pay the actual loss. Now, going to that slide, you see 2-3 points are there. Indemnity. What is this one? The actual loss. Assurance guarantee given by the insurer to make payment of least of actual loss or sum assured. Then in case of underinsurance, law of average will apply, that underinsurance coefficient, he will not pay you more. And in case of damage, salvage value is nil and the salvage value will be property of the insurer. These are the main three plus excess clause. These are called indemnity clauses. But very simple, you can understand that indemnity clause is there means the insurer will pay you the minimum amount of your loss.
Excuse me, sir.
Yes.
While calculating the value at risk at the time of loss,
Yes.
whether the depreciation should be deducted first or the 10% foundation cost has to be deducted first?
Whatever you do, the answer will be same. But only thing is, suppose first you are giving depreciation, then the foundation cost also on the depreciated value you deduct. Okay. Suppose you are deducting the depreciation, but the foundation cost from the original cost you are deducting, it will be wrong. But if you use the coefficients, like 10% foundation, you just multiply by 0.9, both answer will be same. So whether you deduct this first or that first, it will be same.
Okay, thank you.
Insurance is transferable if I purchase the property and I sell it. So insurance is transferable or not?
It depends on the clauses, sir. You have to go through the clause. Some insurance company may allow, may not apply, may not allow.
Please stick to the syllabus only.
In case of property, we have seen that one MCQ. Also, actually, if you transfer at the time of loss, also the insurable interest should be there. So it cannot be transferred.
So one more doubt.
Yeah.
Suppose a property was purchased with bank loan and then a loss happens. So now with whom does the insurable interest lie? The property owner or the financier?
This answer already I had given to other person also asked. I told you, suppose you have your property's insurable value is 60 lakhs. You have taken an insurance of 60 lakhs and you have taken 40 lakhs loan from the bank. Now there are two insurable interest. One is yours, one is bank's. Your insurable interest is whether suppose any catastrophe happens or accident happens, if the property is damaged, you will get 60 lakhs from the insurer. That is your insurable interest. What is bank's interest? Something happens to you, how he will collect that amount? So bank has given you a loan of 40. So for 40 lakhs, he will insure for your life. There are some clauses, if you take a loan, suppose something happens, the loan is waived out, but the bank will be in loss. So bank will make an insurance for that amount. He will collect that amount from the insured party. So there will be two insurance. One is separate. For property, you are only hold the insurable.
Okay, thank you, sir.
We will insure property and bank will insure our life.
Yes, that is what. He will say his insurable interest. His insurable interest is to collect the loan amount. Not more than that he can make. That's what at the beginning also I told. 100 lakhs is property, but you have taken 40 lakhs loan. He can go for insurance of 40 lakhs, not more than that. Case study, all are able to follow. Kindly practice. Don't read that one. You take down those questions, you correct, answer them separately. Then compare your answers. Okay, and we have given number of MCQs we did, around 26. So with this chapter will be very okay.
So this study material will be uploaded on the drive.
That sir will tell.
Already uploaded in the name of Mr. Harihar Rao. There is a folder added in your study material in the name of Mr. Harihar Rao, and all the related subjects PPT will be added here. If there is no doubt, we are compiling the session because already we are 15 minutes late. So, sir, thank you very much for sparing your valuable time. It was a great knowledgeable session. Thank you very much, Mr. Harihar Rao, for this particular session. Thank you very much.
Thank you, sir. Thank you so much.
Thank you, sir. हमारे साथ आगे भी जुड़े रहेंगे.
Thank you for the patient listening.
Thank you, sir. Great.
Thank you so much, sir. Classes were so good, sir. Thank you.
Thank you so much.
Thank you so much.
Thank you, sir. Great lecture, sir. Great
Thank you so much, sir.
Thank you, sir. Thank you so much, sir. Thank you so much.
So friends, this is all from our side for this particular topic. If you are having any doubt, we will take tomorrow also. Tomorrow will be a class and related to this one mail received by some participants. There was a mistake from the education department because some mail IDs were shuffled, and while sorting the name as per their alphabetically order, someone missed the second column, which was along with the name. That's why some mails were sent wrongly to wrong persons. And if your attendance is okay and your all the compliances are okay, no need to worry. And I will show the list because today we are very late and it is a time for dinner also. And we are compiling the today's session. I will try to show the attendance part tomorrow, probably after the tea break, morning tea break. I will try to show the attendance as taken by the observers and as informed to us by the monitoring committee. So thank you, Harihar Rao sir. Once again, thank you very much for this knowledgeable session, and thank you all participants for attending this session in the odd hours. Goodbye, good luck, keep learning, stay safe. We will meet tomorrow morning sharp at 10 a.m. for the balance chapters as per the syllabus. Goodbye. Good night.
Good night.
Thank you, sir.
Thank you, sir. Good night.
Thank you, sir.
Good night, sir.
Bye-bye.